Now we all understand the concept of what goes around comes around. You know what I'm saying? A little yin and yang, everything like that. But it seems like in the last recent years, people haven't really expected that with the market. As we know, pretty much in the last 10 years, if you just invested in S&P 500, you invested in any of the big stock exchanges, that was just going up regardless. You could pretty much close your eyes, throw a dart, you know what I'm saying? And that would give you market success. This is why we've also seen so many Forex stock traders and everything like that, because it was just a market where if you were going long, it was very easy to do. Like even when I was doing a challenge trying to turn $300 into $3,000, a lot of that money that I made was going long. You know what I'm saying? For a large period of time, I just didn't really want to go short because it was going against the grain. So Jim Cramer has some statements about this economy and how he feels that people should kind of take a look at it. We kind of want to get every type of, perspective that we can so we can be as effective as possible. So I think we should take a look at it, and that's exactly what we're going to do here today. Now, like, comment, subscribe to help the channel grow and everything. You guys already know I got tons of love for you, and I just want to make more of these videos for you guys. But I'm not going to hold you up, so let's get into it. All right, so it says Jim Cramer reminds investors that market pain is needed to prevent endless price hikes. Now, like we said, the market goes up and down. You already know if the market goes up 10 years straight, it's going to have a little years of relief. Well, let's see what he has to say. So it says CNBC's Jim Cramer on Thursday reminded investors that pain in the stock market is unfortunately necessary for the Federal Reserve to win against inflation. Okay, so he's taking a stance from the Federal Reserve. I wasn't really necessarily thinking about that. As you guys know, they have played a large part in trying to get this back. And, they've been kind of killing our economy, the flow of our economy at the same time. But it is what it is. Now, he says nobody wants to root for layoffs or lower stock prices, but the alternative is persistently high inflation. Endless price increases for everything, and no one wants that either. That's true. That's true. Now, it says stocks fell on Thursday after fresh data indicated that the labor market remains strong despite the Fed's aggressive interest rate hikes to tamp down rising prices. Cramer explained that while the Fed needs to make it so companies can no longer raise prices for foods, goods, and services, it's inevitable that such a outcome would hurt portfolios. And yeah, that's definitely true. As you guys know, food is getting out of here. It's going crazy. Cardi B, shout out to Cardi B. I don't really like Cardi B, but shout out to Cardi B. She was talking about how she went to the grocery store a few months ago and lettuce was like $2 and some change, and now she pulled up and it was $7 and she was mad. Now, I do think it's kind of important that there's got to be a cap because we can't let this get out of hand. But the reason why the prices are so expensive, is because the grocery stores are having much higher opportunity costs. They're having much higher supply chain costs and things like that. And, if pretty much you put a cap on it, you can get to a point where, like he said, share prices are going to go down because that grocery store will not be able to make the profit margins that it's supposed to do simply because people can't afford it. Now, it kind of sounds bad because it's like, dang, $10 lettuce, like that's insane. But if the grocery store is paying, $8 for their lettuce, and they got to pay employees, and they got to have their buildings, and they have to get stuff shipped, then that could end up being a net negative for the grocery store, and that's why our prices are so high. So it's like you don't want to see the prices high, but at a certain point, thinking economically, you kind of got to reach an understanding as to why this happens, and there is a reason for it. It's not like they just decide, whoop-de-doo, I want to raise prices today. Now, it says lower home prices. It's good if you're looking for a house, but it's awful if you own shares in the home builder Lennar. He says an example. In other words, there's no free lunch for you, the investor. Yeah, and that's just part of being an investor. It's just understanding what type of market you're in. If it's a recession, understanding, hey, I might have to get into commodities. I may have to get into toilet paper. If it's a high period of C-19, you have to understand, okay, I may want to invest in hand sanitizer. Maybe I shouldn't invest in something like cruise ships. When cruise ships, people are scared to even fly, or investing in airlines. That's part of being an investor. That's what makes it difficult to be an investor. But that's also what makes it so lucrative to be an investor, is the people who can really dive out deep, think a little bit, and you know what I'm saying, they'll be able to make those trades, you know, that they can hold for a few months to a few years and possibly gain some extra bucks. Now let's see. It says, while it's unclear when the central bank will be able to roll back its interest rate increases and stop hurting the market, he said the release of the non-payroll report on Friday will shed more light on the state of inflation. If it doesn't show higher unemployment or with no wage growth, the Fed will need to aggressively raise interest rates, which means they'll have to raise it even more. And if you guys don't know, they've been raising the interest rates even more. And it says, he said, if it doesn't show higher unemployment, so that means less people, he's saying more people got to get cut with no wage growth, so you don't have to pay more people, so you can cut more people, and the people that are there, you don't have to pay more. Then the Fed will need to do it if it doesn't show that. So if that doesn't happen, so that means if there is more employment with higher wage growth, then that means that, you know, he's saying the Fed shouldn't need to step in. So let me know what you guys think about this. Do you guys think the Fed is being too aggressive in its interest rate hikes, and that's kind of just slowing down the economy? Actually, a really good question I want to ask you guys too is how you feel about, you know, the potential what is it, setting a ceiling for some of these companies on how much they can, you know, charge for certain things, especially things like grocery stores, you know, commodities, consumer staples, things like that. Do you guys believe that that's something the government should kind of come in, step in, and kind of say, hey, you know, this is getting kind of out of hand. I understand you guys are going to lose a bit of money, but like, you know, the average man can't acquire the same things that he could acquire even 6 months ago. You know what I'm saying? Or do you guys feel like it's not the government's place to tell a company, you know, how much it can charge? Like, the company has to do what it has to do to stay afloat, and the government shouldn't intervene, especially in a negative way, which will hit the company. You know what I'm saying? So I guess it's kind of like, are you rooting for the average man, or are you rooting for the entrepreneur? You know what I'm saying? That kind of thing. So let me know what you guys think about it. Also, like, comment, subscribe to help the channel grow for sure. I'm trying to hit 600 as fast as I can, and I can definitely get there with you great guys. We're going to be coming out with way more content soon. We're going to be hitting everything. And if there's topics you want me to talk about, just send them in. All right, guys, you have a great and blessed day.